Just give you guys some update of the returns. I think the last time when I shared this, right, it was maybe about 50+%. So this past 1 or 2 weeks is a bit crazy in terms of the returns. So it went up further. So now my year-to-date performance is at 64%. Okay, we are how many weeks left? I'm about 3 weeks left to close this year, right? So this year definitely the returns will be impressive. But let's see whether next year we'll continue this kind of bull run or not. Okay, in terms of the portfolio, I think not much update. I haven't really, like rebalancing. I don't do that kind of things. That's why if you look at these portfolio allocations, maybe it's not too different compared to the previous one. The only difference that I can spot is maybe Tesla, because Tesla, the price ran up quite a fair bit recently. So now it's like my second largest position. The rest, I think TSMC, Amazon also doing quite well. We will look at the returns later, and the rest are a lot smaller, so I won't go in details. Let's look at the performance of all the top holdings in my companies. I guess you all follow my channel also because maybe you share similar portfolio with me, right? If you look at Nvidia, 187% return, super impressive. TSMC, close to 100%. Tesla is the ones that changed the most. As you see here, I think even as of early November, just prior to the US elections, I think it was like kind of like break even, right? Then now suddenly just within close to 2 months time, you already shoot up with a positive 56% returns. Tesla return is now officially above Amazon, Apple and Microsoft. So I think that's quite impressive given such a steep increase in short period of time. Then the rest also not doing that bad, right? So for example, Tencent 41%, Apple 27%, and Microsoft 19%. So I think Microsoft is the ones that is a bit like lagging now. I think it's even below S&P 500. Now, just want to quickly take a look at the macro because I think it has been quite some time since my previous update. So I think the upcoming one, right, will be the Fed meetings, 18th of December. 1 or 2 weeks ago, right, if you look at this percentage, right, the market is a bit like not too sure whether we'll get a cut or no. It's close to 50-50. But now, since recent week, I think the chances of rate cut already increased to 86%. So I don't think there will be much surprise here. So I think 86%, I don't expect any surprise here. So we'll probably get one more cut about 10 days from now. After that, I don't know. Will we get a cut in end of January, March? I think that one is a bit uncertain. But it seems that now, if you just look at this probability of rate cut, right, it seems that we generally market is expecting just another 2 rate cuts, even talking about like end of 2025. So I think that's the general expectations. And all this has to do with the growth rate in US and also inflation numbers, right? So that's monetary policy. And then if we look at the inflation rate, right, currently it's about 2.6%. This is the latest one. And next Wednesday, we'll get another reading for November inflation data. So the consensus is about 2.7%. Hopefully this one is not like there's a upside surprise, right? Suddenly we end up with 3% and then go back up to 3.2, 3.5%. If that's the case, right, then I think Federal Reserve cannot cut rate anymore. So I think stock market will be affected. As long as it stays within the expected number, which is about 2.6 or 2.7%, I think that will be all good. The non-farm payrolls, I think this one just came out, the report last Friday. If you look at the job numbers, 227k jobs, new creations, right? I think this is also quite impressive, and it is increased compared to the months before that, which was disrupted by these hurricanes Helene and Milton, right? So I think generally, if we look at US market, right, or US economy, is still very strong. Of course, there's some pocket where US economy is not doing that great, but if you look at it on an aggregate basis, I think for now, there's still not much of a growth concern. That's why I think this is also one reason that we don't expect US Federal Reserve to cut rate to, let's say, like 2%. I think it's because of the strong growth. And if we look at the, overall basis, right, this is corporate revenues numbers. If there's no recessions, you should expect that revenue continue to go up, right? Because companies are making more money, business is good, economy is good, right? So you can see that since 2020 COVID, right, there's a gradual improvement in terms of the revenue numbers. And then if you look at the earnings number, this is operating earnings, it's also continuously going up. So sometimes you look at the stock market, the index level can be going up and up and up, but it doesn't necessarily mean that that's a bubble, right? You should also track the fundamentals data, specifically looking at the revenue and earnings. And here you can see very clearly that the earnings is still going up. Of course, you can make a prediction, say that, oh, I'm very bearish because I think that recession will come and this chart will going down, right? Anyone can make that kind of predictions, but there have been many people who make these kind of predictions but turn out to be wrong. So sometimes for me, my approach is that I don't like to make too much predictions. I know that this kind of things is very hard to predict, but at least we have an eye on the current situations, because whatever that's happened, right? Like today's, are the companies earning more or less? These are the hard data, right? So hard data, they are not lying. They are the hard data. It's just that you don't over extrapolate these kind of numbers. But just look at the numbers here. I think overall corporate profitability is doing great here. Now, let's look at the price multiple, because when people say that, oh, because it's all-time high, market is very overvalued, is it really true? So you want to look at the valuations, right? And valuations, this is in terms of the PE, right? It is just one of the metrics. There are so many metrics, right? Say for example, all this PE go out, it could be because of the growth rate generally picking up, right? There are many metrics, but usually we don't want to complicate things by just looking at one metrics. I think at least it gives us some picture in terms of where's the valuations right now. As you can see here, different blue lines, right? These are different price multiple, whether the current level is at 10x, 15x, 20x, or 25x. You can see that the red line, right, which is the S&P 500 index, right, is already went beyond the 20x. If I just look at the chart here, it is around 25x PE. So you remember, let's say back to 2021 when the market was super bullish, right? There was also about 22. So right now, I would say that the valuation seems to be quite high already. Remember, this is just one metrics. And the other one that I'm following is this equity risk premium. If you look at the red line, right, the red line is the expected earnings yield. So just take the earnings divided by the price, or the invert of the PE. So you can see that because of the price went up more than the earnings, now this chart is trending down. We are talking about, like, let's say 4.5% earning yield. And then the blue line and the green line, this is actually the treasury yield minus the expected inflations and the TIPS. These two, right, what they're trying to say is that this is the bond yield that's adjusted for inflations, meaning that it is a real yield coming from the bond. This one has been quite low for a while already, but recently, just because yield went up, right, so there's since 2020 there's this increase here. It is currently hovering around 2%. If you invest in S&P 500, because S&P 500 is earning like real yield, right, so you should compare against the real yield from bonds as well. So you can see that there's still differences. Like you invest in the S&P 500, the earnings yield is still higher compared to the real yield from the bonds. So that's true. We shouldn't say that, oh, just because of that, then it is always good to invest in S&P 500, because all these things, right, you should look at the historical level as well. Now, if we take the differences between these two charts, right, we get the equity risk premium chart. As you can see here, the delta is only about 3.3%. So this is quite low as compared to historical. So that's why if this line go up and down, right, if you go into market now and let's say there's some sort of corrections, right, then this chart going up again, so that means you will suffer a fair value loss. That's why I would say that yes, continuously investing or continuous with your DCA, I think that's all good, but you have to remember that right now the valuation seems a bit overvalued now. The risk premium is very low. So if you invest now, if you all in now, I think what happens is that if market correct, right, so you will have some losses there. So just be careful on that. My suggestion is always keep a balanced portfolio. Don't all in everything at such an environment, because let's say if the market is super scary and there's a recession, there's a crisis, you want to be more aggressive, I think that's all fine. But right now we are in a bull market, right? So you need to take that into considerations. After looking at all this, right, you see the valuations is high. I think this one you don't really need to look at the numbers. You can also feel that. You look at chat group, right? People are trading, making money. People are like investing in various stocks, right? Could be Tesla, could be other stocks. They're all making money because why? We are now in a bull market. Then there are also some content creators, say for example, Mr. Lu here. If you watch this video, right, he's saying that now the market is already like all-time high. He feels that market is in a bull market. He thinks that it's time to be more cautious, and so he's rebalancing his portfolio. So I think specifically he mentioned that he will put like about 30% of his money in fixed income. So this is just rebalancing. He's saying that this is not market timing, but I would say that between market timing and rebalancing, if you do it on a mechanical basis, yes, that's rebalancing. But I think that he's playing a bit of market timing here also, but which is not wrong, right? Because he's making this kind of movement or this kind of decisions from time to time. Say for example, during market crisis, he really went all in. I'm not sure whether he really went all in, but he fired many shots in the stock market, right? So now the market rally already, he just want to rebalance into some fixed income. So my view on this is that I think depending on your situations, right? Say for example, if you are like me, who is still working, who is still having savings every month, right? So if we don't rebalance, I think that's all fine, because if I deploy in a less aggressive manner, meaning that my saving, I don't put 100% of my saving into stock market, right? I just save a bit in, let's say, SSB, or save a bit in, let's say, treasury bill here and there. So gradually build up my cash positions, right? But still my portfolio is balanced, right? Because there's always this income that come in that is not automatically exposed to stock market. So I use that saving as something that helped me balance my overall portfolio. But let's say if you are someone who is close close to retirement or already in retirement, right? During market is bullish, you might want to, like do a bit of rebalancing so that you have some cash or some liquidity that can help you fund your retirement. It is a bit like, have a portfolio that is not so aggressive, especially when market is towards the overvalued side, right? So I think all these are good idea. What you need to do is just to look at your own situations and then maybe, put together with your own outlook and see how to position it. It is good to keep track of how much money you have in the stock market and how much money that you have in some safe investment, which could include, like CPF or some FD and so on, right? So those are the, the risk assets portfolio and the safe assets portfolio. And this ratio, right, it should be something that you are comfortable with. And if you are unsure, I would say that this ratio, right, it should steer towards the safer ratio, meaning that more towards fixed income as compared to period when the market is kind of like fearful and in a crisis mode. So we want to be more aggressive when the market is scared. But now it seems that market is all bullish, right? I think it's fair to really do a bit of rebalancing there. So for me, I haven't done that kind of rebalancing. You see the portfolio that I've been sharing all this while, right? I've never really sell a portions and then move to cash. I don't really do that kind of things because I think that it's still early in my journey. That one will continue. It's just that when it comes to deployment, I shared many times already, I am quite cautious, especially this year. I haven't really fully deployed my savings. So I have some savings that is putting in treasury bill, some Singapore saving bond, which I haven't really deployed and no plan to deploy in short term. But this pool is still very small as compared to my stock portfolio. So I think this one I shared on X, which I just want to quickly touch on because I pull out these monthly returns from my interactive brokers statements and I saw that it's really quite crazy because if you observe here, right, September, October, November, these 3 months are all green and then December is also green. So we have already 4 green bars in a row. And then this year, right, there's only 2 months that I have a red month, which is July and August. So it's like a lot of green and very little red. And even that 2 months of red, right, is really about 1 to 2% kind of rate. But if you just take a step back and think back, right, during 2022, that was the the high inflations, market is very fearful, and then my portfolio keep on going down and down and down, right? You see, those are the period, let's call it from January 2022 to December 2022. Throughout that year, you see there's multiple months where I have, between negative 6% to negative 10% returns. That was the period when everyone is fearful, right? And that was the period where I really invest in my portfolio and then buying quite a number of companies which already ran out a lot this year, right? I think sometimes we need to take a step back and then just look at all these statements and think back what happened back then. What happened back then is that I really want to invest more, but I don't have cash. That's why this year my strategy or my approach is that although I'm still bullish on many of the companies that I'm holding, but I don't want to use up all my capital, because if I use up all my capital, no cash at all, and then we get into some sort of 2022, right, then I got nothing much to buy. Cash is limited, right? So that's why I want to save a bit of cash there. And it's a good reminder of the period when the market is having a downturn. I think that's us grounded. If not, right, this kind of green after green bars, right, sometimes it really makes us feel like we are the genius. Everyone is a genius in bull market. So I really have this kind of feel right now. That's why I would say that it's good to remind ourselves that let's stay grounded. Market up is good. Stay invested. Don't play too much all this market timing. For those who market time, let's say if you sell your holdings and then think that market will crash, let's say early this year, right, then you already miss out the runs, right? Don't play too much all this market timing unless you are really trader, right? So for me, I'm not trader. This one is really long-term hold, long-term portfolio. Let it stay. But at the same time, need to think of a way to make us stay grounded. That's my feel. So this is the message that I post on X. You can pause to take a look. US market, I think, is really expensive. If you look at my portfolio, which is mostly US stocks, right, I can tell. But it is not that every pockets, right, is expensive. There are some pockets that still, I would say, reasonable, or even you can argue that it is cheap depending on which one we are talking about. So let's say if you don't want to invest your money in US market because you think that it is overvalued, you think that it doesn't make sense to pay this kind of valuations or price multiple to get into US market, you just want to park your money somewhere, but you don't want to park your money in Singapore saving bond or treasury bill, what you can do is you look for some pockets where the market is not so overvalued. I give you one example here. This is S-REIT index. I think this index just tracks largest REITs in Singapore. Quite a list of them. Later I will show. So you can see the index, right? Since COVID period, it crashed down, right? And then it went back up and then slowly it's coming down again. But you have to remember this chart, right, this is just the price chart, because for those who invest in Singapore REITs, right, you will have a continuous dividend income, because you keep on drawing the dividend income already. That's why the price, as long as it stays flat, right, that's all good already, because you get your dividend income, right? So that's why you cannot compare this kind of chart versus S&P 500, because S&P 500 don't have much dividend payout, right? But still, if you look at the chart, right, just look at the valuation level. It's not that expensive. If you invest in REITs today, I think easily you can get, between 4.5% to 5.5%. Investing those large REITs, reputable one, you still can get that kind of yield. And if you do some deep research and you are comfortable in investing in those smaller REITs, right, I think you can even push that yield to 6% or above 6%, right? But those smaller REITs, I would say that usually it is not free, right? Because they are, somewhat riskier. So you need to do your own research into that before you buy into those smaller REITs. But I think just the larger REITs, right, I think if you can get something like, let's say, 5% return, I think that's still quite good. You are not buying at high valuations. So that's why I say this is one of the pocket that you can consider. So these are the REITs, right, that's shown. For me, let's say if I buy REITs, right, I will buy those large and reputable one. One reason is because I'm really lazy. I don't want to do those kind of deep research. To me, all these REITs, right, it's just that the sectors, they are somewhat different. But in terms of the quality of the management, as long as they are the large one, I think they are all fine. It's just that you need to be careful if you go down to those small REITs. Just now I talked about the US, right? Aside from US, there's also other markets that's not so expensive. One example is the overall emerging market. If you look at their forward PE, is only at 12. So 12, right? Even if you compare historical forward PE, right, it's still quite a reasonable valuation. 12 times, right? So if you invert that, that's about like 8% earnings yield. So even if the earnings is not growing, you get 8% returns. I think it's still quite a fair valuations, right? So that's why I think this is also a pocket where the market is still reasonable. And what is inside this emerging market, if you look at the country exposure, right, of course, China is the largest one, followed by India, Taiwan, South Korea, and then other emerging markets. For those who are happy to take on some China risks, you can even invest in China. Just get a MSCI China, right? You can get the forward PE is at 10. So you invert 10 is like 10% return, even if the earnings just stagnant. And then if you do some deep research, you go look into those companies. Some companies actually, their earnings, their revenue is still increasing. Say for example, even the two companies that I invested in, right, Tencent and Meituan. These two, if you look at their revenue numbers, earnings numbers, all looks good. I would say that for China, it's still a market where the valuations is very reasonable. You can even there are many people argue that it is cheap. I do think that it is cheap. It's just that the risk, you need to be comfortable with the risk, because whenever we talk about China, we don't know what's going to happen in 2025, right? Let's say Trump come on with the trade tariff, and then we have all sorts of volatility. I mean, if you invest in China, maybe you can suffer some losses. Then don't come and complain to me, because I'm not a huge advocate, right? To me, it's like I look at the fundamentals, I look at the pricing. You just need to make your decisions on where to park your money. In terms of MSCI China, you can look at their top holdings here, right? Tencent, Meituan, I have these two. The rest I don't have. But let's say if you want to follow Alibaba, you can support Chi Keng, go and watch his analysis on Alibaba. And then I think the other companies, the top holdings here, right? I think these are all solid companies. They have huge moat here. Even Xiaomi, I think when it comes to, let's say, their car, right? They are doing well, executing well. So you see, even Apple try to make Apple car, also they give up, right? But for Xiaomi, their cars is having good review. Their share price also perform quite well. I think all these companies, there's some merits to owning China stock. See you all in the next one. Bye-bye.